Hi there, everyone. As you're coming in today, I want to welcome you. My name is Marcia. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Just a couple reminders: attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter has agreed to answer those queries during or after the webinar today during our question and answer period. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well, and we'll make sure someone reaches out to you after today's event to address that. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. That's what we're here for, and we're so glad you're here today. Well, I'd love to introduce you to our guest today. Blaine Peterman is the founder and lead advisor at Progress Wealth Management. As a certified financial planner, it is his life's mission to provide unbiased financial education, advice, and guidance to help his clients create their path to financial independence. Blaine believes that true comprehensive financial planning can provide the clarity and confidence necessary for families to understand and implement their own well-informed decisions. Blaine's goal is to translate the complexity of financial topics into a simple step-by-step action plan to help his clients understand how to align their money with their personal values and objectives. As a trusted source, Blaine's insights have been featured in articles by Forbes, GoBankingRates.com, The Washington Post, Yahoo Finance, MarketWatch, Business Insider, and MSN. And Blaine, we're so excited to have you here, and I'm going to go ahead and turn the time over to you.
Well, I really appreciate that introduction, and I'm excited to be here as well and share with people a few things that might improve their retirement plans and how efficient their tax plans are as they take retirement income out of their portfolios. Now, the way that I'm going to go through this is first off, we're going to first start off with talking a bit about what RMDs really are, and also what kind of problems they can create for our retirement plans and our financial lives in our older age. And lastly, we'll go over a bit about how to make them smaller, and in doing so, help save you a lot of taxes. That'll be the goal of today's conversation. Now, to get started, what is an RMD? Well, RMD, it stands for Required Minimum Distribution. Now, the IRS, when we have all this money in these tax deferred accounts, like your 401k, or maybe you have got an IRA, eventually they want their taxes. So all this taxes you've deferred for years and years and years, well, eventually the IRS wants their money. That's the idea. And when does that start? Well, it starts when we turn 72. And it typically is going to end up being just about 4 to 5% of the total amount of money you've got in these kinds of accounts, your 401ks and your IRAs. Now, when you take this money out, what the problem is that all that money is going to be added to your taxable income. What does that mean to you? It can put you into a really high tax bracket. It could make your Medicare actually more expensive because Medicare, it's priced progressively. The more money that you make, the more it costs. And that can create some problems. So that's really the kind of things that we're hoping to solve by having these kinds of financial plans and these tax plans to try to make that Medicare stay a consistent price. And also to make it so that you're not pushed into a tax bracket you don't want to be in. 32, 35, 37%, that's a problem. 12, 25, that's a little bit more affordable for most of us. Okay. Now, the last point I'm going to bring up is, before we move on to our next slide, is that I'd invite everyone here. If you've got money in a pre-tax account, I'd recommend you estimate what that required minimum distribution will be. And you can click on the link that's in the chat right now. You can click on it and figure out, well, what do you think that's going to be based on the amount of money you're going to have in that account at the age of 72?
And we've also put the link here on the screen for you.
Absolutely. Now, like I was saying, higher tax bracket, it can make Medicare more expensive. But the biggest reason why that matters to you is that by paying higher taxes, by making Medicare more expensive, it makes your bills higher in retirement. And the best way to make your retirement last longer is to lower your bills. That's why many people, many financial planners say, let's pay off our mortgage before we enter retirement. Well, also, let's try to make Medicare not go up in price just due to a poor plan. And that's the kind of goals that you'd have when you try to end up figuring out, well, how do you end up lowering these required minimum distributions, or RMDs? Okay. Now, the first option, of course, we can push retirement back. Most people's least favorite option, because who says, you know what, I want to work till 75? Few, if anyone, unless you absolutely love your job. But that doesn't necessarily work with every account. It only works with your employer sponsored accounts. And what are these? Well, if you work for a nonprofit, it might be a 403b. If you work for the government, it might be a 457. If you work for a normal for-profit company, it would be your 401k. And by you working, even if you're over the age of 72, you won't have to take these required minimum distributions out. That'll be nice. It could save you a lot of taxes. Also makes it a little easier to afford your retirement if you have fewer years where you're retired. That's the benefit. Now, how do you end up making this work? Well, if you have old 401ks, most people would take their old 401ks and roll them into their current 401k through their current employer. And this also could be money sitting in a rollover IRA as well. Again, you could roll that into your current 401k, no RMDs for you. All of a sudden saves you a good amount of taxes. That could help.
And a question here, what about retirement accounts that are not at your employer?
If you've got an IRA or an old 401k, you'll have to take your required minimum distribution out of that. Okay. But if you roll in your old 401k into your current, no RMDs out of that account. Helps you avoid that. Good question. Now the next slide is about converting, a Roth conversion. Well, many people have not heard of these because number one, they're expensive. And number two, it's something that's typically mainly used by professionals because it's hard to get right if you're not. Now, what is a Roth conversion? Well, let's say you've got a lot of money in a pre-tax account. Let's say you've got $1 million. And you recognize by the time you're 72, it'll probably be worth a lot more. That required minimum distribution could be a much bigger dollar amount than what you actually feel you need to take out of the account. That could end up being a big tax bill you would rather avoid. Now, what can you do? Well, the next big option is to convert a portion of it from pre-tax to Roth. Now, when I say convert, there's a form you can get from Fidelity or Schwab, whatever company you hold your 401k or IRAs with. It'll be called a Roth conversion form. And you'd say, hey, company, I want to convert X number of dollars from my pre-tax account to Roth. And as a result of me doing that conversion, the money will grow tax-free the rest of your life. And that would end up equaling a lower dollar amount that you have in pre-tax accounts. Benefit of that is eventually you'll have a lower RMD. That's the idea. Now the trick is to figure out, well, what tax bracket do you want to stay in? A lot of people would say, you know, Blaine, I don't really need more than 100,000 in retirement. I've got my Social Security paying me and my spouse maybe 60 or 70,000 a year. I only need about an extra maybe 30 or 40 grand. And then that would keep you effectively in the 12% bracket. So maybe you might end up taking some money out of a Roth IRA, some money out of a pre-tax account, some money out of your non-retirement accounts that'll say individual brokerage. Well, you'd meet with your tax professional, your financial advisor, and say, hey, how much room do I have between where I'm at and the top of my bracket? They'd say, well, maybe 10 grand, maybe 20 grand. That's how much you'd convert every year. other people that maybe need a little more money to feel like they're living a happy life in retirement. They may feel they want to reach maybe the 24% bracket or the 22. All of a sudden your income's at 170 or maybe 340,000. It's a little easier to find room in that, right? Just depends on what circumstances you're in. Now, the very last benefit of this is that whatever money is in a Roth, it can be inherited income tax free by your family down the road. So by you doing these conversions, it doesn't just help you avoid a big tax bill at 72, but it also helps your family when they inherit these accounts with whatever money's left over for them. May not be a goal of yours to leave them all the money in the world, but I'd rather leave my family less of a tax bill than more if I had to choose.
I have another question here. When you roll over or when you do a conversion into a Roth, the question is, do you have to convert all the money in the account, or can you do partial conversion?
Great question. Great question. You can do as little as $1, as much as $10 million, as much as you want. And that's where the art goes into it, is figuring out, well, how much should you convert every year? This is typically going to be something you do every year that you're retired. Thank you for that question, though. I really do appreciate
Yeah, really great question. Keep them coming, folks.
Absolutely.
That we love these questions.
Okay. Now, the next big option is I've got many clients throughout the years who appreciate being charitable in retirement. So some of my clients like to tithe to their church or religious institutions. Some of my clients like to give a large amount of money to charities each and every single year. Just depends on who you are. And I always say, if you can end up making it easier to give more to charity by avoiding a tax bill, by all means, who wouldn't want to do that, right? Because if you end up doing these RMDs, you could end up doing it a different way. You can do something called a qualified charitable distribution. And again, this is another form you can get from your broker, like Schwab or Fidelity. And all you do is you could say, hey, I want to give $100,000 or however much money, as long as it's 100 grand or less, to some charity, some church. You can do that, and it'd be completely tax-free. And it would also satisfy your required minimum distribution, which can be really, really helpful. Avoid the taxes, no RMD, give more money to charity, makes it more affordable. Wonderful deal. Okay.
You had a couple questions on the Roth conversion. Can we go back to that?
Absolutely.
All
Go
right.
back to the last slide if you'd like.
Yeah. So one question is, how much do you pay in taxes for the Roth conversion? Can you talk about that?
Absolutely. And that's another great question. Well, depends on how much money you make per year or how much money you have to pay taxes on. So let's just say, for example, let's say you're getting 60,000 a year from Social Security between you and your spouse. And let's say you do a conversion of $50,000. You'd end up paying just about 12% on the whole conversion. But all of a sudden, what if your income another year is maybe closer to 150 or 200,000? Now you'd pay 22% on the whole conversion. The way income taxes work in the United States is the higher income you have, the higher tax rate you pay. So I'd have to look at that a little more specifically for you, or your CPA could help you out with that as well.
All right. Here's another question about the Roth. If you're in your mid 70s, say, you're past that 72 and you're doing your RMDs, can you still roll some of your RMDs into your Roth? I'm not sure if that's exactly what you meant. To clarify that question, go ahead. But Blaine, can you talk about rolling some of the RMDs into a Roth?
Well, so when you take the RMD out, that's considered taxable income, but it's not considered earned. In order to take that RMD and put it into a Roth, you'd actually have to have earned income. Earned income is going to be the kind of income you'd get from working for a company. Maybe if you manage rental properties on your own, you don't have some company doing it for you. That'd also be considered earned income. But just paying tax on money that comes out of IRAs, that's not earned. So you couldn't put that into a Roth. Okay.
Really great question. Thank you so much. And this respondent did say, yes, that's what they meant. So thank you so much for that question.
You could do a conversion though, even if you don't have earned income. So I apologize. We're getting into some of the more confusing stuff here. I don't want to make everybody's eyes glaze over, but I want
That's
to make
okay.
sure I'm giving you accurate education here. Otherwise, we could have problems.
We have another question, but I'm going to hold this one to the end and let's keep going. We talked about charities. Let's talk about this next option.
Okay. So the next option is figuring out, well, in what order should we take money out of all of our different accounts? Because some people have an IRA, some people have a Roth, some people have a normal non-retirement account, like a brokerage account. And the mixture that you use is really, really important because it plays a big role in how tax efficient your retirement is. Okay. Now, the metaphor that I like to use to describe how to think about this is, let's imagine you've got a big old bucket of milk, and and at the very top of the milk, you've got the fat. And then from there, you've got the rest of the milk below it. Now, the fat, that might represent your Roth accounts, because Roth, you can take money out of Roths tax-free whenever you want, or you never have to touch them at all. Really just up to you. And the rest of the money is mainly in pre-tax accounts, as is typical for most households. Now, when you want to take money out of your retirement accounts, imagine you've got a ladle and you dip it into that big old bucket of milk. Well, how deep do you want to go? Do you just want to take out Roth? Do you want to take it and go a little bit deeper and get a little bit of Roth, a little bit of the fat, and a little bit of milk? Or do you want to go all the way down and just take milk out? No fat at all, aka just pre-tax money. Well, the way that you end up doing that really impacts how much milk you get out and how much money you get out at the end of the day. Now, with taking the money out of these different accounts, so a lot of people, when they have a large amount of money in pre-tax accounts and they're worried about RMDs, they'll first take money out of pre-tax accounts first, because that's the bulk of their money. They're trying to get that dollar amount down. So that's oftentimes how people prioritize things. Now, other people might have a lot more money in Roth accounts, and maybe they're not as concerned with RMDs. But still, they'd still rather be a little bit more in control, not be forced to take such a big dollar amount. They still might end up still taking a little bit more. Just depends on your circumstances. But the blend that you have as you withdraw money can play a huge role in your tax bill once you turn 72. That's something that I'm being more general about because everyone's in a different circumstance and it would require a little more art. But if your advisor is not talking to you about the mixture and why the mixture you're using is the one that you're using, it means he probably doesn't have a tax plan. Okay.
So can you talk a little bit about what a brokerage account is in general? I know we're throwing around some terms. I want to make sure we've defined those.
Okay, I appreciate that. So a brokerage account. So many people know what an IRA is and a Roth IRA is, a 401k. What a brokerage account is when you've already put all the money into all these different retirement accounts, you've got some more money left over you want to save. Well, typically people will set up one of these brokerage accounts and you can put as much money into there, take as much money out whenever you want. Okay. The only problem is that there's no tax advantages. So when you buy and sell stock and you make some money on it, you got to pay taxes. When you get a dividend, you got to pay taxes. And that's the problem with brokerage accounts. But the upside is when you're retired, unlike IRAs and 401ks, where you pay tax on every dollar that comes out as if you earned it. Brokerage accounts, you only pay tax on a portion of it. You just pay taxes on the growth. So that's the benefit.
Very interesting. Thank you so much for defining that.
Okay. Now, how a financial advisor can help. Now, typically with most financial advisors out there, when you are evaluating your retirement income strategy, it's not going to be just how do you end up generating the income conservatively that they'll be concerned with, but they'll also be trying to make sure that you're being tax efficient, that you're prepared, and you know what to expect, not just with how much income you're going to receive, but what your Medicare premiums are going to be. What's the worst case scenario look like as well? What if you get really ill or your spouse does? How much can you take out? And what would the tax bill be for that scenario as well? When to file for Social Security and how that plays a role. All these things can play a really important role in how you generate retirement income to make sure you live the happiest retirement that you can. And this is all something that I'd invite just about everybody. If you're looking for a financial advisor, look for someone who's a certified financial planner. Look for someone who's a fiduciary. And look for someone who specializes in retirement planning, working with someone like you. I really appreciate your time with this, Marche. It's been a
Yeah.
pleasure talking with you and been a pleasure holding this. Happy that I can
So,
help all these people.
so we do have a question and answer. Don't go yet.
I'm not ready to go yet. I'm here as long
Yeah,
as you need me.
very good. Well, we thought we would have several questions, so we have reserved a larger portion of the time to question and answers. So if you have a question, go ahead and put that in the chat, and then we'll try to address as many as we have time for right now. Can you talk a little bit about where do you report that you've taken your RMD?
Well, so when you've taken your RMD, the broker that you work with will generate something called a Form 1099 every single year. And typically, when you take those RMDs, those will be reported on your 1040 as if you earned it. So it'll be called ordinary income. I believe it's line 2 of your 1040 to be more specific.
Okay.
So, long story short, if you use TurboTax, if you use a CPA, you just take the 1099, say, hey, CPA, here's my 1099. That's all you got to worry about.
Are there penalties for not taking out the RMDs?
Massive penalty. If you don't take your RMDs out every year, it's a 50% penalty. So let's say you have a $100,000 RMD and you fail to take it. Well, you're gonna owe $50,000 just for that small mistake. Of course, if you've got a 100,000 RMD, you probably got a good amount of money saved in there anyways. You can afford it, but it's inefficient. Not a good idea.
All right. And is everyone required to take RMDs at 72, or is that different? Like Social Security ages can be different.
Everyone's required to take RMDs at 72 who has any money in a pre-tax account. So if you've got money in an IRA, you've got money in a 401k, you will have to take an RMD at 72, unless some of the other conditions earlier in this presentation I was talking about you've fallen into.
All right. Here's another question. Uh, does the money have to be specifically withdrawn with? Oh, I'm not sure if this is this is clear. Let me read it out. But if you want to clarify that, go ahead and put that in the chat. Does money have to be specifically withdrawn from a qualified account, or can the amount of the RMD be withdrawn from a brokerage account?
Has to be withdrawn from a qualified account. And the main reason is because they want their taxes. All that money you've put into that IRA or that 401k, the tax bill was deferred on it for years. And they're ready to get it.
All right. So I have another question here. If you're in your mid 70s and you continue to invest in your IRA into passive real estate investments so that your IRA continues to grow, as a consequence, you continue to pay larger and larger RMDs. How can I reduce my tax burden on the bigger RMDs I must take?
So I'd have to ask you a few more questions. So whoever that is, if you want to put this in the chat, with the passive real estates that you're referring to, are you referring to a self-directed IRA where you directly own real estate? Or are you referring to REITs and those kind of things where you're investing into indexes? Can you put that into the chat for me?
All right, we'll come back to that. Oh yeah,
Self-directed IRA.
self-directed. Okay, thank you for
Okay.
that.
That's a much more complicated question than we've got time to answer today, unfortunately. But likely, either A, you'd have to look into setting up a business, or B, you will. I mean, that's a much more complicated question. Would have to talk about that, and that would take me a bit longer. So I
Yeah,
apologize.
that's
We don't have time
okay.
for that today.
So it is one of those. So one of the things we know on webinars is that everyone's situation is different, and that's why none of this is blanket advice to go out and do that. We do want you to talk to a professional and get professional advice. But that sounds like that's definitely someone you need to talk with your financial advisor and work with your CPA, maybe even your attorney on making sure that those are covered. I'm assuming there are strategies to reduce those RMDs.
Without a doubt. I would
Yes.
say the very first one that would probably come to mind if you're over the age of 72 is likely using qualified charitable distributions if you're interested in being charitable. If you're not, there's not a lot of strategies out there other than doing Roth conversions each year or talking to your CPA to get a little more creative about setting up a business or something to that effect. Those would be other options worth talking about.
All right, good question here. If you have two 401k accounts, do you have to take the RMD from each account, or can you take the total RMD from one account?
Total RMD from one account is perfectly fine. As long as you take the money out, the IRS gets their money. That's all that they care about.
Even if they're at two different custodians?
You'll get a form 5498 from both of them. So let's say if one 5498 says you have to take $1,000 RMD, the other one says another 1,000. Well, you could take both 2,000 out of this one or this one. They don't care.
That's a great question.
Yeah.
What if your RMD is your only source of, oh, you know what? I didn't have all that question here. Go ahead and write that question again about if your RMD is your only source of income. I wasn't sure that you finished that. Oh, here we go. It's your only source of retirement cash. How is your income tax rate calculated?
So no Social Security, just an RMD. That's the total amount of money you're working with. Typically, the way that would be calculated is, I mean, let's say it's a $50,000 required minimum distribution. So that'd be called ordinary income. Now, let's say you've got the $50,000, you're retired, so no other income at all. You'd have your standard deduction, which would be 12,500, I believe, this year. So if you're married, 12,500 times 2. If you're not, just the 12,500. So that means the total amount of income you'd be paying taxes on is about $38,000 or $37,500. That'd be about a 10% tax rate, just about. That's all you'd pay is probably about a total of $3,700 in taxes.
Thank you. Here's another question. What is the backdoor Roth conversion? They've heard about that, but they're not sure what that is.
Okay. Well, the backdoor Roth conversion is if you make too much money, the IRS says you're not allowed to put money into a Roth IRA. You make too much. And you can't go through the front door because they say you can't contribute the money to a Roth. But it doesn't have any rules against converting money into a Roth IRA. Okay. So what people do is they set up a traditional IRA and a Roth IRA, and they put the money into the traditional IRA over here, and they don't take a deduction. And then they take the money and they convert it into the Roth. And by doing that, you bypass the income limit for doing a contribution to your Roth because it's converting it. It's not contributing. 100% legal. Literally thousands of people do this every single year. Now, a caveat I'll add to that is that if you have other IRA accounts where you've taken the deduction, when you do that conversion, you'll have to be a little bit, you should talk to your CPA, your financial planner about it before, because there's some rules I don't want you to break that could cost you a lot of taxes and money. Now, this is only can be done when you're still working. And yes, at any age, but you have to have earned income. Working for some company or if you own real estate, you can call it real taxable income because you work on the property yourself. Yeah, you can do a contribution to an IRA, convert it to a Roth, any age.
And you would have to be earning some portion of a living. You would have to be employed. Does that count for self-employed people as well?
Yeah, absolutely. You have to make the amount of money you can put in there, though, is the lesser of either $6,000 or the dollar amount that you earned. So if you earned less than $6,000, you can only do however much you earned that year. But if you made over $6,000, or actually over $7,000, my mistake, if you're over the age of 50, if over the age of 50, you made over $7,000, you can put the full 7 in there, no problem.
All right, we have a couple more minutes for questions. So I'm going to go ahead and take the rest of these questions here as much as I can. I will remind you if we haven't had a chance to get to your question, go ahead and leave your contact information in the chat and we'll make sure someone reaches out to you after today's event to make sure those are addressed. Going back to the charities, are there certain charities that are not allowed to be contributed to that don't count as those qualified charitable distributions?
Yes, they have to be a qualified charity. So I'd recommend if you're thinking about doing a qualified charitable distribution, to contact the charity itself and say, I'd like to talk to the donations department. Typically from there, they'll be able to clarify if you can actually do that distribution. But I've never heard of a single religious institution or any qualified nonprofit that you're not permitted to. I haven't heard of a single one quite yet, but you might prove me wrong. So might check. Always a good idea to check.
This is a good question. Can an RMD go into a trust for a minor or a disabled child? And will that be taxed?
RMD, it can be deposited into a trust that benefits a disabled child or your children. You'll still have to pay taxes on it, just like any other RMD, because it's technically not a qualified charitable distribution, right? But yeah, it absolutely can be deposited into it without a problem.
So it's just like taking money out and buying something. It's just that's where you put the money.
Yeah.
That there's no tax advantage to that.
No tax advantage at all.
Okay. All right. All right. Here's a good question. When do you actually pay the taxes? Like, do you pay the taxes at the point at which you take the money out, or is it just on when you file your taxes?
Great question. Depends on what you prefer. I've got some clients who say, Blaine, I don't want to have a hassle. I think my tax rate's going to be 15% or maybe 20%. So when we take these RMDs, why don't we withhold 15 or 20% so I don't have to worry about it come April? I don't have to worry about the money being in my bank account ready to go. Other people say, Blaine, I think with all that money I'm going to owe them in taxes, I might be able to make an extra 1 or 2% on it, maybe even more between now and April. Why wouldn't I do that? End of the day, it's just 1 or 2%, maybe a little more. So some people don't feel like they want to have to worry about it. Up to you.
And when you say they hold that back you mean, is it like in a separate account, like with your brokerage, or tell how that kind of works.
When you take your RMD, you'll have to fill out this form called an IRA distribution request. That's what they call it. And on that distribution request, it'll say, how much taxes do you want to withhold for your state and for the federal taxes? And when you'll put in a number there and you'll submit it. And once you submit it, they'll say, okay, well, John Smith over here said he wanted to withhold 20% federal taxes. It's a $10,000 RMD or distribution. So we're going to withhold $2,000 and pay it straight to the federal government. You'd get $8,000 as a result.
Well, that's all about all the time we have for questions. We want to thank everyone for their questions. We want to thank Blaine for being here and providing all this great information. Thank you so much. And thanks to the organizations that have made this webinar possible today. I will pop this slide up one more time.
Yeah.
This link to estimate your RMD, that is a link to an organization. You said that was a educational organization for CPAs, correct?
Mm-hmm. Yeah, 360financialliteracy.org is a purely educational website. It has no advertisements. It's purely there to just help society make better financial decisions. And that calculator will help you have a pretty accurate estimate of what that required minimum distribution would be. The hard part is figuring out how much money you're going to have exactly come December 31st.
And so I'm assuming that's why if you don't have a financial advisor, if your financial advisor isn't a good fit for you anymore, that's what we would encourage you to use our services here at Advice Chaser. We're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming. We will be sending out a replay of this event so you can watch it again and hopefully share it with friends and family if it was useful to you. Thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
I appreciate the opportunity to help you all. Have a good night.